Well, hey guys, thank you for joining us. We're going to talk a little bit about the bond market and really what's going on as of today. Really, there's been a lot of changes. I'll share my screen. I'm David. I know we're about a minute late, so a minute early, so we'll let the people queue up and get going. Before we go on 15 after the hour, it's been a wild ride. I can say that for sure. Obviously, a lot of you guys know that the bond market hasn't been doing very well, specifically since COVID and probably since all the inflation. But we've seen a major turn of events probably over the last 4 to 5 weeks, specifically about 4 weeks ago. Yields started to come back down, and they've come specifically very highly down. It's 10 years trading at a 426 right now. It's trading roughly at a 5% not terribly long ago. So we've seen a big change in yields. We've seen a big change in markets and a lot of change in buying patterns. So it's right at 15 after the hour, 4:15 Eastern time. So we want to get going. Let me share my screen so you can kind of see it. And there you go. So that's who we are right there. So first of all, thank you for coming. I hope everybody had a wonderful Thanksgiving, spent time with their family, their friends, and looked at this year as a thankful year. So I hope everybody did have a good Thanksgiving for sure. I'm David. I work with all the team at DRL. We're based out of Houston, and I've been doing this for about 30 years now, specifically in the high-grade bond market. AA rated, tax exempts, a little bit of corporates. Our book of business, if you're wondering, is made up of about 80% high grade paper and on the muni side, and about 20% BB to BBB rated corporate paper. And the corporate paper is primarily for riskier accounts that wanted paper, that are in lower tax brackets, that want to stand the risk of corporate paper. But our bread and butter, so to speak, is high grade munis, odd lots, anywhere between 25 bond pieces to 250 bond pieces. We're classified as a dealer on the street, so we're what's called a liquidity provider. We have about 650 to 700 retail accounts, and we have accounts that have been with us for 20 or 30 years, and obviously we're still growing accounts now. We have a team of salespeople, and then of course traders that buy and sell securities for us with our accounts as well. So getting into the webinar, that's kind of a little bit about us. Getting into the webinar, that slide there is something from a compliance standpoint. We need to have that on there for the attorneys. So, and this is going to be recorded and put on our website as well. So definitely go out and check that out for sure. And I'll try to get to the Q&As as well as we go through the webinar. But if you have questions as far as what's going on, feel free to go and give us a call. Our telephone number will be on the last slide. And of course, our email will be there as well. You can look us up on drlgroup.net. So how can we help? So I mentioned we have about 30 years personally, I do, in the bond market business. Probably collectively, we're close to 150 years in the bond market. We've traded through or at least I've traded through everything you can think of. When I first got into business, Orange County, California filed bankruptcy. That was the largest bankruptcy. That was August of 1994. And Orange County, that was the largest bankruptcy besides Whoops, that went into bankruptcy and restructured. So we lived through that. And obviously a lot of things since then, and we don't really need to go into that. But the bottom line is that we've seen a lot all the way up to today. We really strive, and I'm not going to hit all those bullet points, but we really strive to give our clients very timely and precise information, not on equities, if it pertains to bonds perhaps, but more so from an economy standpoint, what the Fed is doing, how the Fed is reacting to different economic numbers. We had economic numbers come out today. We report on that. We usually send something out every Tuesday and Thursday. Usually we'll send offerings out on Thursday and news out as well. We do have a blog as well, chasingyields.com, and that we put on some blog posts, and we'll get into that in a minute. The other really main important thing on that slide that you really need to know is that our back office, our clearing and custody firm is Fidelity. It's National Financial Services, which is a wholly owned subsidiary of Fidelity. So our back office, your securities, we custody with Fidelity is our custodian, and we feel real comfortable about that. And we really like that aspect of it. So getting into the issue, and this is what all of our clients have been really asking us specifically over the last 4 weeks, and really maybe even the last 3, did we see a bottom in pricing and a top on yields? If you are a bond buyer, you've been buying bonds for a while and you're seeing paper, which is great for you. We might have seen a bottom. It's kind of hard to say whether we saw one or not. But at the end of the day, it's really hard to say. We saw 5% for a very short period of time. And with that said, that went away extremely fast. And if you're a bond buyer, you know exactly what I'm talking about. Now, this presentation is really going to be geared for AA rated credits all the way across the curve, say 2 years to 25-year paper. So if you're buying high yield paper and you saw 5 and you're still seeing 5, then that's great. This is not the presentation, and that's not geared towards that. That's something we don't trade, and that's something that we really don't get into. But AA rated insured paper, we did see a 5% for a brief period of time. We were very heavy buyers, all the way from basically a 450 to about a 510. And now all of a sudden we're hard pressed to get a 5%, and you'll have to drop your coupon pretty significantly in order to do that, meaning down to the 3% handle range. Interest rate risk has been an issue. It's been an issue for the last 2 years. The reality is that if you own bonds, and if you've owned bonds for greater than 2 years, you've seen your account go down in value. Whether you own mutual funds, whether you own individual bonds, the fact of the matter is the bond market has really been a difficult market to be in for the last couple of years, for sure. We felt the pain. I'm not going to pretend that we avoided it, because we didn't. I'm not going to pretend that we told everybody to sell everything before we saw inflation, and quite frankly, we didn't. But with that said, most of our accounts are bond buyers for the long haul, and they buy and sell securities only really when the time is right. But the reality also is that most of our accounts are buy and hold, and so they're buying securities to hold for an income stream. The income stream, of course, doesn't move up and down, but we have had interest rate risk, which quite frankly is still a challenge even today. And we'll get into that. But the reality is, with the 10-year sitting at a 4.25, you got to start to wonder whether or not we're a little bit overbought in here. But again, we'll get into that in a second. Overall, we feel rates are going to grind lower as a global perspective. I'm not talking about tomorrow, and I'm not talking about yesterday. I'm talking about from a global perspective. Over time through 2024, we're going to see rates grind lower, unless we see something that we didn't see, like a COVID as an example, which hopefully, of course, that won't come back. But overall, rates should grind lower. And the Fed, we believe, has indicated that they're done. They're finished raising rates. They feel that, hey, look, we feel that most of this stuff is going to have to sink in for a little while. I think we're up 555 basis points, 550 basis points. And so with that said, most of the Fed out there, with the exception of 1 or 2, have said that we're done. We need to really let this stuff soak in. Their next meeting is the middle of December. The conclusion or the consensus out there is that they're going to hold rates the same, and they're going to hold rates through January. Some are calling that they're going to cut rates in May of 2024. They could. We believe that it's a little too early for that. It'll probably be closer to June or July. But with that said, if the economic numbers continue to deteriorate, then we'll probably see a cut sooner than later. I'm not suggesting it's May. I would say probably July and 25 bips, and then we'll probably see another 25 bips a couple of months after that. Buying paper right now, particularly over the last couple of days, has been extremely challenging, meaning that paper's out for the bid. You put a good bid on it, you want to buy it, you put a price on it, and you think your price is fair and equitable, but it doesn't trade. So it's extremely difficult to trade, which leads to that last point where bid and ask is extremely tight. So that really means that, okay, well, we can't buy paper based upon the fact of the bid and ask. So we put out some questions. I'll stop sharing for 1 second. So we put out some questions on this webinar, and the questions were, the first question was, well, why are my bonds down, right? Why are my bonds down from that standpoint? So that was really the first question. Why are my bonds down? Well, it's pretty easy. We've already kind of gone over that. It's outflows, it's inflation, obviously it's movement on Fed hikes, and it's CPI numbers. That's it. Your bonds, if you're buying quality bonds, are not down because they're bad bonds. They're going into bankruptcy or they're restructuring. They're down because of the fact that we saw major outflows in 2023 and quite honestly 2022 and some of 2021 as well, to where we saw these major outflows come in and say, okay, hey, look, mutual funds are selling. There's not enough capacity to absorb all of those bonds. I don't care what business you were in, whether you're in oil and gas or if you're selling Nike tennis shoes, it doesn't make any difference. If you've got more than what you can possibly sell, what ends up happening? The price has to go down to make that equalize to where you've got call it a balance of buyers and sellers. I'm not suggesting that's the only reason bonds are down, but that is a huge reason why bonds are down. And these mutual fund people were selling paper left and right to satisfy redemptions that were coming into these funds. So as Oppenheimer or Nuveen or Vanguard or BlackRock or whatever fund you own, they had to meet those net redemptions in order to do that. That's your CPI number, what you're looking at now, that graph you're looking at. The peak inflation happened around June of 2022, as you can see down at the bottom. We've gradually started to come down. Powell started, this whole transitory thing. Hey, inflation is transitory. We feel that it's going to go away. Well, at the end of the day, obviously, I'm not going to say it was wrong, but it wasn't right. It was very interesting to see how the inflation mechanism moved the needle on interest rates. And if you've traded through it before, you know that is the detriment to fixed income securities. Quite honestly, equities got hammered as well, but fixed income securities got hammered. That was pretty much the peak. And so as we started coming down, we started to see some sort of a stabilization in overall bonds itself. So with that said, that's what we've seen going forward. With the next slide, that is really what you're looking at. Peak inflation. It took about a year for munis to gain traction, meaning that once we hit peak inflation in June of 2022, we still had munis trading down. Even though CPI numbers were coming down, we still had munis trading down pretty much monthly. And so as munis traded down, it created this, okay, well, we feel that this is never going to end. And my munis are going to continue to trade down, so I might as well sell. So you had this herd mentality almost, where you had these exiting people moving out. And of course, they locked in these losses, so to speak. And now they're kind of questioning. And if you're smart, maybe you've gotten back in, but now they're kind of questioning, okay, well, where's the bottom? Well, we started to see 5% out long, probably call it 5 weeks ago. And when I say 5% out long, I'm talking a 5% coupon at par or a discount out long, meaning 20-year paper. So we did start to see that. Now, you could have bought during the peak of this 4% 1-year, 2-year paper as well. Obviously, that's now trading about 100 bips cheaper, 100 bips more expensive than that. So it's trading roughly at around 3 to 3.25 to 3.125%. But most folks out there were trying to lock in call protection and trying to lock in maturity. Most dealers out there, including us, as I mentioned earlier, believe that rates are going to move down over time. I'm not here to predict when that's going to happen. But over time, rates should be moving down. We're already seeing that. We started seeing that. We saw it huge today. We saw it huge yesterday. It's only 2 days, but it is what it is. But with that said, with this going on, with rates moving down, prices move up. Well, going back to the original question was, why are my bonds down? Well, the reason is because of this right there. 550 basis points, unprecedented. I mean, you know, last time it happened was back in 2004 and early 2005. And that was not as much as what we saw now. The Fed used their tool, I should say tools, because they really stopped buying treasuries as well. And they started to raise these rates. What did that really do? Well, of course, if you bought a 4% coupon when it was right here and you paid 116, then that 4% coupon right here was probably worth 94 or 92 or even 86. Did the 4% coupon stop to pay? No, it didn't. If you're buying quality, is the value of your statements down? Of course. And that's what everybody's dealing with right now. But now are you saying, okay, well, you loved it, or your broker, or we loved it at 116 or 112 or 110. You should be buying the heck out of it at a dollar price of 93, because quite frankly, nothing really has moved from the standpoint of credit quality. Are bonds yielding 5%? That was another question we had. And we have 6 questions. That's all we're going to cover today. It's pretty simple. The reality is it's a tough decision. If you were to ask me, are bonds yielding 5% 2.5 to 3 weeks ago, I would have said absolutely yes. These PowerPoint slides I worked on these for the last literally 2.5 to 3 weeks. And when I started developing these PowerPoint slides, we were in a 5% environment. We were buying 5% all day long, and clients were loving it. We were showing our clients what was going on through either emails or reaching out to them through outbound calls. And we were making sure that they knew where paper was trading and whether they wanted to buy paper or not. Keep in mind, we're a dealer, so we trade paper first to our client to make sure that our client gets the paper that the client is looking for. And then we trade to the street, typically at a higher level. So we try to give the client the better deal, usually is the way we operate, and we can get into that. Longer dated paper will be your best bet. If you're looking for 5%, you're going to have to get down to a 3% coupon, and maybe that might even be gone at this moment, but pretty much all 4% out long, trading roughly in the high fours, call it a 475 to a 490 maybe, and that's a big maybe. With that said, we're seeking 5%, and we're currently trading 5% at the time the slide was generated. And this is not a sales pitch. And no matter if you do business with us or not, or if you're an existing client or not, it is fading. And quite honestly, it's already faded. The reality is now is that the greed factor has what I call kicked in, and 5% seems to be the number of what everybody is looking for. Okay, I like 5%. That's a 7.5 or 8% taxable equivalent in my tax bracket. It's insured. It's going to give me a good income. Let's buy 200 bonds. So we're seeing that kind of mentality. When we saw that mentality, by the way, there's a ton of cash on the sidelines. So as that cash moved out of money market accounts, which was earning about 5.25 to where ours is paying 5.25 taxable, people were like, okay, well, I'd rather move that into a tax exempt entity from that standpoint. Like I said, point number 2, you can buy 5% coupons at this time, but 5% yields, but you're going to have to buy lower coupons in order to achieve that. With new issuance coming out, we're seeing new issuance come out this week, next week, and the week after. So usually in December, you're going to see the first 3 weeks, the last week of November, and the first couple of weeks of December, where there's a tremendous amount of new issuance. And why is that? Well, it's pretty simple. Municipalities want to get the debt booked off their books, booked into the street, raise the money going into 2024 in this case, and get it done. So we're seeing a lot of that. Typically, that usually holds yields up. Usually we see a glut of paper come out, and we are seeing that, but we're seeing it absorbed in the dealer community. People truly believe yields are going down. Again, this is not a sales pitch, but it is what it is. Fear factor from T-bills. When I wrote that slide, T-bills were really trading. The 10-year was trading probably at a 475 when I wrote that slide. Currently, as I mentioned, it's at a 425, so we're down 50 bips from that. There was some fear factor. The fear factor was, what is China going to do? What are the European nations going to do with our debt? Are they continuing to sell? We know the Fed is kind of out of the market right now, but the main issue at the time was that we continue to have to issue debt, treasuries I'm talking about, in order to service debt and or grow the economy. And people are very concerned about that. Quite honestly, we are as well. And they continue to issue debt. The auctions, which are issuance of debt, have gone fairly well. What's called the bid to cover has been really tight over the last 3 auctions. So that tells you, not to talk in technical terms, that there's a lot of demand right now for treasuries. I don't know if there's something out there that people are seeing, that there's something on the horizon, or if they're saying, hey, we feel comfortable with this, perhaps a recession on the way. I don't know, but all I can tell you is that treasuries are definitely trading up right now in price, down in yield. And with that said, there's a tremendous amount of buyers out there. I mentioned we have a blog, chasingyields.com. I would advise you guys to take a look at that and bookmark that along with our website. We put a notification out on that blog on October the 18th of 2023, and we indicated there was a UBS article that was published that day, and we agreed with that UBS article saying that, hey, listen, this might be the time to purchase securities. We put it out on the blog. We pushed it out to our clients. And what ended up happening is that when that October 18th article came out, all of a sudden that seemed to have been some sort of a turn in the market. As you can see, this is around October 18th. Think of this as price, not yield, but think of this as price. So prices October 18th, and this is what we've done since October the 18th. So prices have significantly gone up. If you look at your account, whether you look at your account with us, or if you look at your account with your existing broker, online, you see your account values up fairly heavily this month, for the month of November. Obviously, we have a couple of more days to go, but it's going to look like it's going to be a relatively good November, which is going to be a welcome change. We trade based on the yield curve. The yield curve is it's a fancy way of saying, hey, look, where's 1-year paper trading? Where's 2-year paper trading? 1-year paper trading, 2-year, 3-year, 5-year, so on and so forth. So this is 4.6% up here. That's usually the benchmark of yields. So when you hear yield curve, or when you talk about yields, you really want to look at the yield curve to make sure that you, as the client, are getting a good deal based upon what you're purchasing and the credit quality as well. So if you're buying AA rated versus AAA rated, and you are making sure that your yields are going to be applicable to those credit ratings, obviously to the maturity dates as well. We were, at least when this thing was written, we were getting 5%. Now that's not true. We're probably getting more like a 480 now, but nevertheless, we're still getting roughly, call it 115 to 125 basis points higher than where we were, say, in January of 2023. So we're still good. But the next question that we kind of fielded, and by the way these questions came about was that we're fielding these questions through our own book, and we sit on panels with other dealers and talk to other dealers daily about what kind of questions they're fielding. So these are really, quite honestly, the top 6 questions that we've seen. Is it the right time to buy municipal bonds? It really depends on what your objective is. I mean, if your objective is to buy and hold, it's really a good time to buy munis kind of any time. And I know that sounds like a cop-out. I know that sounds very watered down. But if your objective is, hey, I'm only going to time the market and I'm only going to inject $2 million in a market and then hold off and then inject another 2 million when the yields go up again, you're going to lose out on a lot of income. And I'm not suggesting buy all the way through, but what I am suggesting is really take a look at your objectives. Are you a buy and hold, or you really want to try to time? Are you only looking for high yield? What are you really looking for? It's a great time to buy munis, in our opinion, specifically right now. Yes, 2 weeks ago would have been better. Does it really make a lot of difference? And this is what you really have to ask yourself. Does it make a lot of difference if you buy a 5% coupon at par or if you buy a 5% coupon at 101? Is it that big of a deal? And really, I know people kind of get hung up on that, but it's really not. In the grand scheme of things, bonds are a long-term instrument, and it's a long-term hold, and they're slow instruments. And they're going to do exactly what you want them to do: pay you an interest, tax exempt, either get called or mature. Period. End of story. So you're going to get your money back one way or the other. Or you're going to get your par value back, I should say. So yeah, these levels haven't been seen in a long, even now, they haven't been seen in a long time, 16-ish years. I mean, it has been a long time since these levels have been here. So don't get, not that you are, but don't get hung up on, golly, I woulda, coulda, shoulda bought 5% 2 weeks ago. It's not going to make a lot of difference. Buy 4.5 now. You'll be super happy when that thing trades at a 4. So, just really think about that. What's really certain for 2024 is that we're going to need 405 billion of supply to keep up with demand. Look at those numbers. There's only roughly 256 plus 149 billion in interest. So whatever that comes to, 300 or 400 billion. So that's about an even, and I'm not counting any new clients coming on board. Most bond buyers go, hey, listen, if my bonds mature, I'm just going to go ahead and reinvest those proceeds, continue to send me the interest, but I'm going to reinvest. There's not going to be enough supply in 2024 to satisfy the demand. Is the yields going to go down for that? Probably not. Are the yields going to go down for that and CPI numbers and inflation and a possible recession? Probably so. So what does all that mean? I mean, the reality is that supply and demand are going to be a little bit offset because of the fact that there's not going to be a lot of paper to go around. And we're already starting to see that. That came from Bloomberg from the standpoint of 2024. If you're buying quality insured paper, and we only stick with specific insurance companies, which we're happy to talk about offline, then you should be okay. If you're buying higher education or healthcare, I would be a little careful. You need to be sure you know what you're purchasing. Make sure that you know what the underlying credit quality is. If it's a weak credit, make sure that the credit on top of that, meaning the insurance company, is a solid insurance company that can cover what's called the claims paying ability. We are big in local and state general obligation bonds, which everybody on this call probably knows what that is. We're fairly big in transportation. We're very big in public power, and we're very big in water and sewer. We do not trade a lot of healthcare, although we do some. I'm in Houston. We have a lot of good healthcare systems in Houston. MD Anderson comes to mind. Texas Children's comes to mind. Obviously, the Mayo Clinic, of course, which is not in Houston. So all of these things come to mind, and we trade specific things that really make sense trading. Is the Fed going to raise rates again? That is a very, very common question. If you were to ask the street, say 8 weeks ago, people were like saying, I think they might in December. 6 weeks ago, I don't know. 2 weeks ago, probably not. Right now, probably not. Many think the Fed is done. The Fed has telegraphed that they're fairly well done. They haven't said we're done. I want to be real clear about that. Quite honestly, I don't think they will. But they haven't said that we're done. What they have said is that we believe things should soak in for a while. What does that mean? They might wait for a while. An interesting fact, after this long of a move, which I think the last move was in, I know the last move was in the summer, then historically, over the last, call it 12 years, the Fed hasn't moved rates after this long of a wait. Is that going to set precedents? I don't know. I wouldn't say it does, but I'm giving you a fact to where the Fed has not raised rates after this long of a let's call it a hiatus from the last move. So we'll see. But anyway, that's a fact. CPI continues to move lower, which is interesting, particularly over the last 3 reports, which is understandable. And some are calling for a rate cut in May of 2024. Again, I mentioned earlier, I think that's a little bit too early, maybe June, July. Either or, whether it happens or not, whether it's May, June, July, we think yields are going to continue to go lower, which means prices should rebound from that standpoint. Fed policymakers, 2023, they projected that maybe we'll see some more rate hikes, but now that is kind of fading. Their final meeting of the year is the 12th and the 13th of December. The Fed has said that, hey, we're going to take a wait and see attitude. We are in a data-related society right now. I mean, let's face it. I mean, everything is surrounded data. I mean, Amazon Web Services, Google Web Services, all of these guys are gathering data. Data is king. The Fed is no different. I mean, let's be honest with one another. The Fed is pulling all this data. They're making decisions from this data. Watch that data as we go through, because that's going to really give you an idea. The reality is most likely they're not going to raise rates, but that's enough of that. So since the last Fed meeting, they have received positive news on jobs. I know it's really sad to really think about as bond buyers, but the reality too is that if the jobs numbers are weak, or the unemployment benefits go up, or spending goes down, or remember back in high school, you're studying economics and bonds. Okay, well, bonds love bad news. I mean, that's what I remember. I mean, that's unfortunately what's happening right now. Bonds are benefiting from this lower economic. What you're looking at right there is unemployment numbers. So those numbers I pulled actually 3 days ago, you can see that those numbers are obviously going up. And that was COVID, of course. That's the big issue there, which everybody knows what ends up happening. We kind of moved in this I don't know what you want to call it, more like a trough pattern of anything else. And now these numbers are coming up. As you can see, historically, I mean, this goes back to 2000. I hope you can see that. But jobs numbers really don't move that much unless you have, this is 08. Obviously, I traded through 08. If you traded through 2008, you knew the world was coming to an end every single day. You came in, you went, oh my God, I don't know what you do for a living, but whatever you did for a living, it was like, holy moly, what's going to happen today? I mean, Lehman Brothers, Bear Stearns, Countrywide Mortgages, WAMU, I mean, you name it. It's just like, okay, whatever. So with all that said, of course, jobs numbers piled up on this from a standpoint of here. But as you can see, they've been relatively calm, and we're seeing this move up. And so if you're looking for this big spike like this, that's not going to happen. And of course, if we have COVID or something like that, but in a normal environment, that's not going to happen. My point is that don't walk away going, well, jobs numbers hadn't really moved up that much. Well, it doesn't have to move up that much. That's the key. That's the reality of it. And that's the reason why Fed is like pausing. Home sales, pretty simple. Economics 101. I mean, if you've got a 3 3/8 mortgage on your home, which I doubt you even have a mortgage, but if you do, then, if you're going to move and you're going to get a whatever, 7.5% or whatever the mortgage rates are now, they're certainly lower today than they were 2 weeks ago. Then why would you even move? I mean, it's unless you're going to pay cash for the house. So it's pretty obvious. So you've got all of this stuff going on. You've got these labor numbers weak. You've got CPI numbers that are weak. You've got sales on homes that are weak. So you've got these issues. That, by the way, that reads fresh 13-year low. I hope you can see that. You've got all these things that are weak. So what does this really mean from a bond standpoint? Well, again, kind of looks like yields are going down. That's kind of what we're kind of getting at. How high will yields go? Well, that's really hard to say. And when I ask our kids something and they give me some answer like that, it's like, okay, well, give me the answer. Don't just give me some BS answer about this. It's hard to say. It really is. I kind of think we've topped out. I do also think, by the way, that we have gone too far too fast with this rally as well. As I mentioned, we were at 5% 2.5 weeks ago, hard pressed to get it now. I kind of think we're going to get a little pullback in here somewhere. I could be completely wrong, but we'll see what happens. I think yields overall, if you're a long-term investor, have topped out. And that's a pretty easy statement to say, because the only thing that's really going to push these yields up significantly is something, if CPI numbers spike, then yes, obviously that's going to push yields up. If labor numbers go down, meaning that unemployment goes down and job openings go down, then obviously that's going to make yields spike. So I mean, those numbers are important. And we're coming into the holidays, and usually labor numbers are relatively good, meaning that they're down a little bit because there's temporary employees that are working. But the system is smart enough to know that, okay, you've got a company that has 2,000 employees and you're going to hire 300 of them. So all of a sudden you've got 2,300 employees. Well, the system's smart enough to know that those 300 employees aren't going to be there after January 15th. So the reality is that I think we've hit the top. I don't think we go straight down from here, but we are advising our accounts to say, hey, listen, if you've got capital, we've got a lot of cash in money markets. If you've got capital, this is a good time to buy. If you got some profits and we can replace, which we're doing quite a bit of, if you got profits and we can replace with better bonds, lower dollar price, higher yield, we're doing that as well. So this is really kind of we'll call it a sloppy market, meaning that we can sell paper significantly higher than what we can buy paper for at this moment. So we're really going after that trade at this very second. Fear of missing out, that's usually the way we come about, right? So you want to go to a concert and you wait and you wait and you wait, and then all the tickets are sold and you kick yourself because you could have had 2 tickets on the best seats that you could have bought and took your spouse and or your friend, and now they're gone. Well, that's kind of what's happening with the bond market. The train is leaving the station, and we're really seeing dealer activity, which this is activity that you're seeing. This is activity in tradable QSIPs. And so as you can see, this activity has significantly moved up recently, quite frankly. And so the train is leaving the station. Trading volume is heavy. If you look at a lot of these big banks, JP Morgan reported, Bank of America reported, Wells Fargo reported. If you dig into their reports, a lot of their municipal bond trading desks have had a record month, because not so much because they're making a lot of money on each individual bond. They're making small spreads like we are, but we're doing a ton of transactions. So that's really what's happening right now. I think that will continue, quite frankly, and that's going to push yields down because everybody's going to be competing for the same stuff. Overall, I mean, I'm talking from a global. What is it going to take for the yields to move lower? I think we've established that. We really don't need to go over this slide. CPI, PPI, and jobs, producer price index, consumer price index, and jobs. And you can throw homes in there too if you want, but the reality is that we've already covered that. We don't need to spend a lot of time on that. What's priced in the markets? Well, the Fed seems to be done. 5% is pretty well gone. What's priced in the markets? We don't need to spend a lot of time on this slide either. You know what's priced in the markets? Fed is probably going to pause, and we're probably going to have rate cuts middle of 2024. That's what's priced into the markets. If we're wrong, then we're probably going to go back to a 5 to a 5.10. We're not going to a 5.25, and we're not going to certainly to a 6 unless we see something, unless there's something on this in this economy that we're not seeing, and we can't plan for that. But what I can tell you is that what's priced in the market, rate cuts are priced into the market. That's what's priced in. Why are bonds yielding so high? It's a repetitive question. We don't really even need to go over this. Why? I think we've learned why. Why is because of the fact that we're dealing with inflation. There's a lot of people that believe that in the Fed, by the way, that we probably should hold off and see what happens and let this sink in. Everybody was, ton of cash out there, and everybody was hiding in a hole because their account values were going down every single month. It was difficult, and it still is difficult. But now, if you're a bond buyer and you have capital, I'm not calling for a, hey, buy everything here. That's not the point. But the point is that talk to your broker, talk to us, look at our stuff, understand the market, because it is a decent time. There are 3 keys for 2024. Here you go. The 3 keys are: liquidity concerns continue to impact muni markets. What does that really mean? You know what that really means? There are a lot of dealers out there that are getting out of the business. Dealers like us that are getting out of the business because of the fact that, 1, it's too expensive. 2, there's not enough product. 3, quite honestly, the spreads are thin, which are okay with us because we make it up in volume. And 4, they don't have the expertise or they're retiring. So there's this collapse of dealer community out there in the muni bond markets that have not traded through various things, that don't know what to do. I'm not suggesting, we're the best. But what I am suggesting is make sure you're dealing with somebody that understands the market and has been in it for a long time, because there are factors out there that people don't quite honestly understand. While recession has turned to somewhat of a dirty word, and I'm not going to read that per se, the whole thing is that, is the economy going to slow? There was a time when a lot of folks out there, a lot of bond buyers, quite frankly, thought, okay, well, the economy is going to slow and the bond market's going to do fantastic. Well, it doesn't seem like it's going to happen. It'll probably slow, but probably won't go into some deep hole recession. And then the changing market, you as an individual bond buyer, make up a tremendous amount of the market out there. It's shifting from people buying mutual funds to buying individual bonds. Why is that? Because people are getting sick and tired of buying a fund at $36 a share, and all of a sudden there's a whole slug of people that want to sell it, and now it's at whatever, $30 a share. They didn't want to sell it, but the dividends are cut because they had to sell securities in order to satisfy those net redemptions. Whereas if you're buying an individual bond, yeah, I'm not saying the price isn't going to go down. We're not dumb, but at least your coupon is going to stay the same. So you're seeing a shift from mutual fund purchasing to individual asset class purchasing, individual CUSIP purchasing, so to speak. Tax exempt bond buyers can take comfort if we do have a recession. They have navigated recessions very, very well from the standpoint of what's going on in the past. So with that said, and that slide really needs to be up there a little bit longer, some of the challenges we see, bonds have done well as an asset class post and during recession. I'm not calling for a recession. If we have one, I think your bonds are going to do well. If we don't have one, I still think your bonds are going to do well, because I think yields are going to go down. And we've pretty well established that on this webinar. Where are bonds trading and what are we buying? Well, we try to buy 5%, but obviously that's not going to happen because the yields have moved down so much. Mid-range trading roughly at around a 3.75 to a 4. That's probably about right. Short year, 1 to 3 year paper, 3.5 to 3 3/4. That's probably about right. We're buying across the curve. We're really focusing on, say, 5-year paper, 10, 15, 20, 25-year paper. We're not buying a lot of 1 to 2 year paper because, quite frankly, if we buy 1 to 2 year paper and then we have those bonds mature in 2024 or 5, overall, you're going to be investing in something lower, I think, unless you just need the money, then that's okay too. Preferably 4% coupons or higher. Those seem to hold up better. I know everybody out there, or I shouldn't say everybody, but a lot of people have lower coupons, and you saw those lower coupons got hammered. So, 4% did too, but 4s and 5s seem to hold up a little bit better. We believe yields are going to go down. We've already established that. Credit ratings, we didn't talk about that, and I'm not going to go on to that, but credit ratings are going to stay strong. We believe credit ratings, and not just us, but S&P and Moody's feel that credit ratings are going to be strong throughout. I think, I would have thought taxes would have gone up. Obviously, we're going into an election year, so I don't think the Biden administration is going to risk that. If taxes were going to go up, they would have probably gone up a year or two ago. So I think taxes going up is probably off the table, quite frankly. Deep sell-offs, anytime we see a deep sell-off, we're always a big buyers, whether that be for our clients or for a prop desk. We're big buyers from that standpoint, and volatility, obviously, we've already touched on that. That's the last slide. That's who we are. That's our contact info. As I said, we're here to help. We would love to talk to you, whether you're a client or not, whether you want to open an account with us or not. We would like to talk to you if you want to talk about the bond market from the standpoint of our view as well. So it's really interesting to talk to people and get their views as well. I've got time for one question, and we've got a few up here, but do you advise clients to stagger? So stagger maturity dates, I presume, which stagger maturity dates. It depends on, again, it depends on the objective. I'm not going to cop out on that, but usually what we do is we try to stagger the call dates. So if we have a 5 or 7 or 10 year call date, because most of this stuff's going to get called anyways. So we try to stagger the call dates. If the client is dead set on saying, I need 5, 10, 15 year paper, obviously we do that. And we're very good at that, by the way. But if we have a client, most of our accounts are going, look, I want max yield within a reasonable amount of maturity, say 15 to 20 year paper, 25 year paper. We'll try to focus on the call dates from that standpoint. This product is very liquid. You're going to be able to sell paper if you need to. Obviously, market conditions dictate what the price is going to be, but the product is very liquid. So I think that you're going to be okay. And then the last one is I'll answer the last question. What's the outlook on calls in the near future? If yields continue to go down, which let's assume that they are, and treasury prices continue to go up, which I don't know if that's a good assumption or not. I mean, I'm looking at the Bloomberg. We're at a 4. We're at a 4. I'll put that over there. Well, we're at a 425 right now based upon where we're at. And I mean, that's a huge move. I would say calls would go up. I would say that your callable paper is going to be called. I don't think that yields are going to spike. And so if you have a callable piece of paper in 24 through say 26, I would think that they would either pre-read that or call it when they can. So I would say that overall calls are going to go up for sure. I would think. I would wager that they would go up. I would anticipate calls being, because let's face it, if yields continue to move up as we saw in 23 and 22, why, the old adage is, why is a municipality going to call bonds? Then they can call bonds for various reasons, but I suspect that calls will go up. That's it for the webinar. We really appreciate it. We hope to talk to you. If you have any questions, definitely let us know, and we're here to help. And thank you for your time. And again, I hope everybody had a wonderful Thanksgiving and happy holidays to everyone. We'll have another webinar probably at the end of January, 1st of February, which will kind of talk about the end of the year and what the outlook will be and so on and so forth. So good luck to you guys. Have a happy holiday, and thank you for joining us.